15 milliseconds. Less than the time it takes to blink. Yet in that gap, millions of dollars change hands. This isn't about speed, it's about access. The moment you hit buy, your order is already late. Not because you hesitated, but because someone else saw it coming. Prices move. Opportunities disappear. And you pay more without ever being told why. No rules were broken. Nothing illegal happened. And still, you were late. Because in today's markets, the game doesn't start at the same time for everyone. Time is no longer neutral. It's packaged. It's sold. And milliseconds are reserved for those who can afford them. So who is buying those 15 milliseconds? What do they see before everyone else does? And here's the question that really matters. If someone can always move first, is the market still fair? The answer may change how you see every trade. 15 milliseconds. That's faster than a blink, faster than a snap, faster than your brain can register a new thought. But in the world of modern finance, 15 milliseconds can mean everything. It's not just speed, it's control. In that tiny sliver of time, trades are executed, prices are altered, and money quietly shifts hands without you even knowing you were too late. You open your trading app, you see the price, you hit buy on your screen, everything looks smooth, instant, but behind the scenes, your request travels through routers, cables, and exchange servers, and by the time it reaches the market, someone else has already acted. They didn't guess what you'd do, they saw it coming, not because they're smarter, but because they're closer. Faster. The market was meant to be the great equalizer. Transparent, fair, level. But what if speed has quietly broken that promise? What if time itself is no longer neutral, but a product sold to the highest bidder? 15 milliseconds, that's all it takes. Not to cheat, not to hack, but to win. Legally, consistently, quietly. Because this isn't a glitch. This isn't a one-off. It's the system working exactly as it was designed to. The public feeds you delayed data. The private feeds them opportunity. By the time you see the move, they've already profited from it. You're not just late. You're the reason the price moved. And you never stood a chance. You didn't lose the trade. You were the trade. Every time your pension fund makes a large buy, they're there. When your index fund adjusts its holdings, they're there. They skim the surface, microscopic slices from billions in motion and leave before anyone notices. They don't need to hold. They don't need to believe in a company. They don't even need to know what it is. All they need is to be first. First by milliseconds. So ask yourself, who's selling those milliseconds? And more importantly, why are they for sale at all? Imagine a race where the finish line never moves, but the starting gun fires earlier for some. The runners look the same, wear the same shoes, breathe the same air. But a few of them, only a few, hear the signal before the rest. They start running while the others are still waiting. And by the time the rest take off, the winners are already claiming the prize. That race is the modern stock market. And what separates the winners from the rest isn't talent, intelligence, or even luck. It's timing. Timing measured not in seconds, but in milliseconds, or even smaller. And the earlier you hear the gun, the more you can win. This is the world of high-frequency trading, or HFT. At its core, it's not about making smarter bets. It's about making faster ones. HFT firms build their entire strategy on speed, shaving off milliseconds wherever they can. And to do that, they need to get physically closer to the exchanges, not metaphorically, literally. They pay millions to put their computers inside the same buildings where trades happen, not a city away, not a room away, just meters from the servers. It's called co-location. And in this business, being 5 meters closer to the action isn't just convenience. It's money. Inside those buildings, behind locked doors and under flickering fluorescent lights, rows of machines hum in unison, each one programmed to act in microseconds. They don't sleep, they don't second guess, and they never hesitate. Their only job is to react to incoming data faster than anyone else. When a new price update flashes across the exchange, these machines are the first to see it. They're wired into the exchange directly. That's not a figure of speech. Fiber optic cables connect them straight into the bloodstream of the market. But even fiber optics have limits. Light only travels so fast through glass. So the arms race continues. Some firms have built their own private microwave towers to transmit signals through the air. Because light moves slightly faster through air than it does through glass. Entire companies have spent hundreds of millions of dollars just to build straighter, faster lines between Chicago and New Jersey. Not because they trade more, but because they trade first. When the difference between winning and losing is a single digit in the 4th decimal place. These tiny advantages stack up. Imagine a stock priced at $100. One firm sees that a large order is coming in to buy it. If they're fast enough, they can buy it at $100 and sell it milliseconds later at $100.01, 1 cent in profit. Not impressive unless you do it hundreds of thousands of times per day, across hundreds of stocks, across multiple exchanges. The volume makes it matter. But to do this, they need more than speed. They need priority. When your order goes into the market, it doesn't teleport. It's routed through networks, sometimes taking different paths, depending on your broker, your location, or even the specific exchange. Some routes are longer than others. Some introduce milliseconds of delay. HFT firms study these paths like cartographers. They map out every possible route, every possible detour. They find the cracks where orders slow down. Then they position themselves to slip in ahead. This is not guesswork. It's engineering. Data centers are measured in heat, vibration, and nanosecond noise. Algorithms are refined not just for logic, but for latency. Even the operating systems are stripped down, removing background functions that might slow execution. In some cases, they write custom code directly into the hardware. Zero overhead, zero margin for delay. And yet, none of this is visible to the average investor. You open an app, you see a price, you click, it feels instant. But what you don't see is the queue. Your order enters a crowded hallway of data. It gets processed, prioritized, and matched. If someone else submitted their order just slightly earlier, by a few milliseconds, they get the price you thought you'd locked in. You get what's left. The firms doing this aren't breaking laws. In fact, they often operate with the full cooperation of the exchanges. Why? Because exchanges profit from selling access. Colocation isn't free. Premium data feeds aren't free. The fastest paths come at a price, and HFT firms are happy to pay. In return, they get exactly what they need: visibility and velocity. This relationship creates a subtle but powerful incentive structure. Exchanges benefit when speed becomes valuable, because then they can sell more of it. That means there's no natural reason to level the playing field. In fact, it's profitable not to, as long as there are firms willing to pay for advantage, and as long as that advantage remains legal. The system stays tilted, not broken, just quietly unequal. And the result is a market where speed itself becomes the commodity, not the stock, not the strategy, just the ability to react first. Some call it liquidity provision, others call it parasitic, but either way, it's real, and it's everywhere. Even the layout of exchanges is optimized for speed games. Some redesign their systems to favor the fastest traders, letting them peek at order books, just a blink before others. These small glimpses, in the right hands, can become powerful predictors. If you see that 10,000 shares are about to be bought, you can step in milliseconds ahead, buy first, and sell moments later at a slightly higher price. It's legal, it's fast, and it works. All of this leads to a strange paradox. A system built on fairness, now optimized for advantage. A market where more participants than ever can trade, but where only a few truly win the speed game. You can have a better strategy. You can understand the fundamentals. But if you're not first, you're already behind. And the market doesn't wait. The question isn't whether speed should exist. It's whether selling speed creates a hidden cost for everyone else. And whether we're willing to accept a market where victory belongs not to the wise, but to the wired. Speed alone doesn't explain the full story. It's not just that certain firms can react faster. It's what they do with that speed that changes everything. The real power lies in what's known as latency arbitrage, a form of trading where the tiniest difference in timing creates opportunities for profit. It starts with data. Every moment, the market produces an endless stream of IT price updates, order book changes, volume movements. This data is sent out from exchanges to everyone in the market, but not all recipients are equal. Those closest to the source receive the data first. That means they see changes before others do. They know when a large order is being placed. They know when a stock is about to tick up or down. And if they're fast enough, they can move in the sliver of time between when the information is released and when the rest of the market reacts. That sliver, that gap, is where profit lives. The process follows a precise chain. First, data is received. Then, it's analyzed instantly by purpose-built machines. Not human traders, but systems that process hundreds of signals simultaneously. They compare patterns, detect anomalies, and calculate probable moves. Within microseconds, an algorithm makes a decision. It might buy shares on one exchange and sell them on another, exploiting a small price difference. It might front-run a known trading pattern, placing orders just ahead of anticipated demand. It might cancel hundreds of orders per second, scanning for reactions. Then, the trades are executed instantly and automatically. The trades aren't risky. They aren't based on long-term value or corporate fundamentals. They're designed to be temporary. A position might last milliseconds. The goal isn't to invest. It's to skim, to extract value from timing mismatches. This is the advantage pipeline. See first, compute faster, act instantly. Those who control this pipeline don't need to predict the future. They simply need to be first to act on the present. Consider this. A mutual fund places a large order to buy stock in a major company. The order is split across multiple exchanges to avoid moving the price too much. But HFT systems detect the first piece of that order as it hits one exchange. Within milliseconds, they infer the rest is coming. They race ahead to the other exchanges, buying the stock first. By the time the mutual fund's remaining orders arrive, the price has already moved up because the HFT firm just bought what they wanted to buy, and is now selling it to them at a higher price. This isn't illegal. It's not even hidden. It's algorithmic anticipation made possible by faster access to public information, but it distorts the market in subtle ways. The mutual fund paid more. The price was no longer based on natural supply and demand. It was manipulated, momentarily, by those with an edge in timing. Multiplied this by thousands of orders, every minute, across every major exchange, and the scale becomes hard to ignore. There are other forms of latency advantage. Some firms specialize in cross-asset arbitrage, exploiting timing differences between related securities. If the price of a stock moves, they anticipate changes in options, ETFs, or futures linked to that stock. If a commodity price moves in Europe, they might race to adjust related instruments in the US. The faster they detect, calculate, and act, the more consistent the gains. And the gains are real. Some high-frequency firms have reported making money on over 95% of their trading days, not because they always make the right bet, but because their bets are engineered to avoid risk altogether. They don't hold positions overnight. They don't wait for quarterly earnings. They're in and out before volatility even begins. It's not about making bold predictions. It's about exploiting structural inefficiencies, tiny, recurring mispricings caused by time and fragmentation. This all relies on the fragmented nature of modern markets. Stocks don't trade on a single exchange anymore. They trade on dozens each with its own matching engine, its own order flow, and its own latency characteristics. This fragmentation creates natural cracks. If one exchange updates faster than another, or if orders are routed unevenly, brief discrepancies emerge. And for firms who can move faster than those discrepancies resolve, each moment is an opportunity. At this point, you might ask, is this good for markets? The answer depends on perspective. Proponents of HFT argue that it adds liquidity, narrows spreads, and increases efficiency. And sometimes, that's true. But critics point out that much of this liquidity is fleeting. It disappears under stress. In a stable market, speed traders are everywhere. In volatile moments, they vanish, because they're not required to provide stability. Their presence is voluntary, and their goal is to win, not to help. And so, the average investor is left in the dark. They see the surface of the market, they see the price, but they don't see the layers underneath. The real-time arms race, the constant cancellation and resubmission of orders, the predictive algorithms that chase large trades before they land, all of it is hidden in plain sight. The system is legal. It is documented, but it is not understood, and understanding is the key. Because while these strategies affect professionals the most, to mutual funds, pension managers, institutional desks, their impact trickles down. When large orders are skimmed, when trades cost more, when slippage occurs again and again, the cost is passed along, in higher fund fees, in lower returns, in the silent erosion of long-term growth. And most importantly, it chips away at trust. Trust in fairness, trust in markets as a level playing field. Because when milliseconds can be monetized, when time itself becomes a product sold to the fastest bidder, something fundamental has changed. Not visibly, not dramatically, but deeply. The next time you make a trade, ask yourself this: who saw it coming? Who moved before you? And what did they take in that tiny, invisible moment? Because in this system, profit isn't just earned, it's timed. You don't have to understand high-frequency trading to be affected by it. You don't have to see the algorithms or know what latency arbitrage means, because the cost of speed isn't always measured in data or money. Sometimes, it's measured in trust, and that loss is felt not by machines, but by people. Layla is a teacher. She doesn't follow the markets closely. Every month, A portion of her salary is automatically invested into a retirement fund. A portion goes into stocks, another into bonds. She doesn't check the numbers every day. She trusts the system to work for her over the long term. The contributions are small, but over time, they grow. That's the promise she believes in. But what Layla doesn't see is that every time her retirement fund places trades, it's entering a race it can't win. When the fund buys shares, it splits large orders across multiple exchanges. The intention is to avoid price impact, to get the best average price. But before those trades complete, high-frequency firms detect the pattern. They jump ahead, buy the shares first, raise the price, then sell them back to the fund at a fractionally higher price. Layla loses a few cents per trade. She never noticed, but multiplied over years, over thousands of trades, across millions of participants, it becomes something real, something taken quietly, something that leaves her with a little less than she deserved. Then there's James. He works in a trading firm. 10 years ago, his job was to analyze companies. He studied earnings, tracked management teams, followed industry cycles. But the job changed. Now, he spends most of his day studying patterns of order flow, how fast signals move, how predictable large trades are, which exchanges are slightly slower than others. He doesn't look for value anymore. He looks for footprints, clues, anything that suggests where large money is going, so his firm can avoid being taken advantage of, or, if they're lucky, step ahead of the line. James is not unethical. He's tired. His screens show streams of numbers in green and red, flickering endlessly. His stress isn't about losing money, it's about losing milliseconds. Every micro delay means someone else got there first. Every moment of hesitation means someone else profited. He doesn't sleep much, and when he does, he dreams in price ticks. This wasn't the career he imagined, but the market doesn't reward patience. It rewards precision. His job isn't to think, it's to outpace. And then there's Mary. She's sick. She retired this year after 4 decades as a nurse. Her pension is managed by professional state funds, actuarial experts, conservative investment committees. She was told her savings were safe, diversified, built for the long term. But the reports she gets now confuse her. Growth seems slower than expected. Fees feel higher. When she asks, she's told the market has changed, that volatility has returned, that returns are compressed. What no one says is that her fund's large, routine trades are routinely intercepted. Not illegally, not even visibly, but, predictably, every time her fund buys or sells, the market moves just enough to affect her bottom line, just enough to make sure she pays more when she buys, and gets less when she sells. Marisol won't run out of money, but she'll have less flexibility, fewer choices. She wonders if the market is still working the way she was told it would, if fairness is something you can still count on. All 3 stories are different, but they're connected, because the market is not just numbers and charts. It's people. People with jobs, dreams, futures. People who believe in systems they can't see, but depend on. Systems that promise efficiency, but sometimes deliver complexity without clarity. The human cost of latency isn't dramatic. It doesn't come with headlines or crashes. It comes in the quiet erosion of returns, in the stress of chasing milliseconds, in the confusion of a system that's no longer built for participation, but for competition on a scale most people can't access. Even inside the financial industry, many professionals operate at a disadvantage. Not every firm can afford microwave towers. Not every trader has access to premium data. The gap between the fastest and the rest isn't just wide, it's growing. And the faster the few become, the more fragile the rest of the system feels. This fragility isn't obvious. Most days, things work. Markets open, trades flow, screens light up, but the foundation is tilted. The rules are asymmetrical, and that asymmetry introduces doubt. For the everyday investor, it's not about beating the machines. It's about trusting that the system isn't silently stacked against them, that they're not simply there to provide liquidity for someone else's edge, that their long-term plans aren't quietly eroded by high-speed skimming. And for the professionals inside the system, it's about remembering what markets are supposed to be. Places where price reflects value, where information is shared, where competition is fair, even if outcomes aren't equal. But when fairness becomes a premium product, when trust is something you have to buy, it's not just the numbers that suffer. It's the very idea of what a market is. Because you can't feel a millisecond pass, but you can feel when something isn't right. And the hardest losses to measure are the ones you never knew you took. They didn't build a faster stock market by accident. They built it because someone asked the question, What if we could trade just a little quicker than everyone else? And the answer turned out to be profitable. Not for everyone, but for those who could afford the infrastructure, the access, and the proximity to act in milliseconds. The system didn't break. It evolved quietly, precisely, and completely. Every cable laid, every microwave tower raised, every algorithm refined, every millisecond shaved down. All of it was part of a larger strategy, not to cheat, not to hack, but to get there first. And it worked. But now we're left with the consequences. A market that runs faster than its participants can see. A game where most people follow the rules, but only a few can afford to shape them. A system that offers the appearance of fairness, while selling the advantage of speed behind the scenes. Some say this can be fixed, that we can slow the system down with speed bumps, intentional delays that level the playing field. Others push for batch auctions, where trades are grouped and executed in intervals, eliminating the edge of speed altogether. There are those who call for transparency, equal data for everyone, at the same time. A market where the same light shines on all. But these ideas faced resistance, because speed is profitable, advantage is valuable, and the incentives that built this system still hold it in place. So maybe the better question isn't, can we fix it? It's, do we even want to? Because the truth is, most people don't notice what's happening. They feel it slightly in their portfolios, in smaller returns, in creeping doubt, but they don't see the root cause. It's hidden in the milliseconds, invisible in the interface, deliberately outside the public conversation. And that's the real cost, not just in money, but in trust. Trust that markets are fair. Trust that effort and patience still matter. Trust that the game isn't quietly tilted from the start. You don't need to know what an exchange router is to be affected by it. You don't need to know what latency arbitrage means to pay for it. If you invest, if you save, if you trade, if your retirement or your child's education depends on the financial system, you're part of it, whether you realize it or not. So where does that leave us? It leaves us with a choice. We can keep pretending that fairness and speed belong in the same sentence. Or we can admit that something has shifted, that the future of finance won't be decided by strategy or vision, but by who moves first and who's allowed to. 15 milliseconds may not sound like much, but it's long enough for someone to see your move, get in front of you, and sell it back at a higher price. Long enough to turn public infrastructure into private profit. Long enough to win before you even had the chance to play. And if we accept that, what else are we prepared to accept? At the dark side of success, we don't just tell stories about systems. We question the incentives behind them. We follow the money, the timing, and the silence. And this time, we followed 15 milliseconds into the heart of a market. That's faster than fairness. If this made you think differently about what equal access really means, if this raised more questions than answers, or if you simply feel that this story deserves to be seen, then we have one request. Subscribe. Because there are more systems to explore, more shadows to illuminate, and more truths hidden in plain sight. And while others race for milliseconds, we're staying just long enough to ask the right questions. Let us know what you think in the comments. Is speed an innovation, or is it the most sophisticated form of manipulation ever built into a public system? Thank you for watching. We'll see you right on time.